Welcome back to our earnings corner. Bank of Baroda's first quarter results were a mixed bag. Very resilient net interest margins, but higher slippages due to an overseas loan and a slight uptick in personal loan NPAs. But the net interest margin was the cynosure of everyone's eyes. It fell by only 7 basis points. Remember, for many private banks, the margin has fallen by between 15 and 25 basis points. But can the margins see lower levels now in the current Q2 and in Q3 because of the rate cuts? Also, can loan growth maintain this 12 to 13% run rate that we saw in Q1? For all these questions, I'm joined by Mr. Debadatta Chand, Managing Director and CEO of Bank of Baroda. Good morning, Mr. Chand. Thank you very much for your time. Well, first up, it is the margins question. You all controlled it well in the quarter gone by, but will it take a bigger chunk in the current and next quarter? Have you any estimates?
Thanks, Latha. Good morning. And as far as the margin is concerned, it is typically because of the rate transition that is happening on the economy. And as you said, right, that the book has shown a resilient in terms of the margin cut as far as Bank of Baroda is concerned. So going forward, what we see that major part of the repricing, the full quarter impact we are going to see in the next quarter, that is Q2. And this quarter, the full impact has not come. So there can be pressure. At the same time, on the deposit side, we are seeing significant repricing. That means the interest expenses is going to go down for the next quarter. So net to net, there would be impact, but we are not looking at a significant impact on the net interest margin in next quarter. That's why the full year guidance we are giving at 2.85 to 3, with a quite bit of hope that Q3 and Q4 will be much better than the Q1 and Q2.
Okay, so you're expecting the recovery in Q3 itself. Q2 you think will be the bottom?
Yeah, that's right. Q2 would be the major impact Q2 would take, but Q3 and Q4 would be much, much better.
Okay. Well, the other point is, of course, on slippages. There is, of course, as you pointed out in the investor presentation as well, that there is one international account, but there was a bit of pain in the personal loan account. Can you take us through the slippages picture and how it is evolved now? You're already 2 months down in the second quarter. Can you give us an idea of how slippages might pan out sector-wise?
Yeah, as far as the slippage is concerned, even if with the international account, we are well within our guidance range of 1 to 1.25. And because this international slippage is one-off, so excluding that, the slippage ratio would be at 0.99, which is comparable with the slippages we have seen in the earlier quarter. Our normal run rate on slippage per quarter is roughly around 2,800 to 900. So in that, the bank is well within the slippage guidance, and excluding this one is all comparable with the earlier quarters. Saying so, on the personal loan, on the legacy book, we have seen some 100 of crores slippage, but in terms of slippage ratio, because the denominator is also increasing, the slippage ratio is well within the comparable parameters with the earlier quarters. So we are not seeing any elevated level of slippage going forward. On the collection efficiency is much better now. The credit book looks very, in terms of the SMA 1 and 2 looks much better now. So we are not thinking of the asset quality of the bank is quite robust and resilient enough to take care of any impact because of the slippage going forward.
No, I'm not saying that you will be in trouble at all, sir. After all, you'll have historically low NPAs of 0.6%. There's no question of any problem. But what I'm asking is that, is there any vertical, for instance, unsecured personal loans or MSMEs, or any, international book where you may see pain? Have you already noticed in the first 50 days of the current quarter?
Yeah, as far as international book is concerned, again, the asset quality is quite good. And this particular account is a one-off clearly. So other than this, there is absolutely no other account which has any sickness as on today. Secondly, on the domestic book, only on the retail advances, we have seen some 150 crore of additional slippage as compared to the last quarter. And precisely, as I said, that because of legacy personal loan book, the slippage has been there. But as a strategy, earlier the personal loan used to grow at much higher pace of 30, 40, 50%. We have moderated to 20% this quarter. And I don't think, this additional slippage is because of the legacy book. On the current book, absolutely no stress therein. So, but in case you compare the slippage ratio, then it is well within our earlier quarter slippage on the personal loan.
Okay. Just one number came to my eye when you have a page in your investor presentation, which says that the MSME loan NPA was the highest. It was 10,600 crore. In everything else, it is, the next big is agriculture, which is 7,000. Then is retail, 5,000. MSME 10,600 is standing out. Is that likely to give you any trouble at all?
No, not. See, MSME, there are a percentage of this outstanding is again because of different government scheme. The government guaranteed they are in the credit guarantee coverage is there in those NPA outstanding.
Oh.
So, but at the same time, if you look at the slippage ratio for MSME, because the MSME growth last year was 14%, and this quarter it is almost at 12.4%.
Yes.
Considering that the denominator is also increasing. So what is important here to take note of is a slippage ratio. So in terms of ratio, we are not exceeding our earlier slippage ratio in MSME.
Okay. Yeah, there is a 13% rise in MSMEs and 17% in retail. Yes, but 13% is a fairly robust number. Let me come to credit offtake. Credit growth on the overall number looks very good, even if it is a Q fall. That is to be expected. After all, the March quarter tends to be very strong. And with the start of the monsoons, Q1 does not match up to Q4. But can you repeat a 12% growth?
On the overall advance, absolutely. Our guidance is 11 to 13%, and this quarter also we're at 12.6% on the advance growth. So only the RAM segment, which is retail, agri, and MSME, almost growing on an organic book 18%. So that's significant. At the same time, the corporate, typically the first quarter of the year, we do a bit of realignment. What I mean by saying that, because we have reduced the bulk deposit to the extent of 23,000 crore. So obviously the fine price asset typically because there is a repricing happening, so we could not do those transactions. So the corporate growth is 4.2%. If you compare the corporate growth of 4.2% vis-a-vis the last year, the same quarter, that was at 2.5%. On a full year basis, we could achieve around 9 to 10%. And we are hopeful also this year that on the corporate also we are going to have something around 9 to 10% for the full year. Saying so, the RAM continued with a growth driver. And this time the RAM growth is almost 18%. But I expect at least a 15% growth for the full year on the RAM side also. So RAM growth of 15%, corporate growth of 10% typically would put us into around 13% growth on the advances side.
Okay. I hope you know that you are on the higher level in terms of guidance. Practically no one is guiding 13% on the street. Certainly not the private sector banks. They are closer to 10. What's the likelihood of the ROE going down in the current quarter? You all are very close to 1%. And there are a few people out there who worry that it may go down below 1 because the NIMs will be under pressure. You think so?
So look, the ROA has been in excess of 1 for last 12 quarters now.
Okay.
So a scenario that where the bank is actually the book is quite resilient in terms of both profitability and also growth on the top line. So the full year guidance again we are giving that the ROA has to be more than 1. The quarters where the NI is slightly bit a challenge because of the interest rate transition, we're able to optimize on the other income or the non-interest income.
Okay.
So going forward, I think we'll be in a position to maintain our guidance of above 1 ROA for going forward. Okay. As you talked about the ROE, as the bank is generating enough profitability, so ROE is almost at 16%. So going forward, again, when you grow, because I believe there is enough opportunity in the market for us to grow, then the ROE also is going to have it is currently very strong and going to be strong. I'll just give you a few of the bank's book. Look, one of the key piece of the bank's entire book is the way the liability management has been. At a cost of deposit of 5.05, at a CASA percentage of 39.33, at a domestic NIM of 3.06, I think the bank book is well positioned to capture all the opportunity that the market offers. At the same time, also, in case any headwinds because of the geopolitical scenario, also the bank book is quite capable of handling it.
Okay, fair enough. I'm not doubting that. And even if there is a dip, it is expected only for 1 quarter, not for the full year. The other issue I wanted to know is that, in your various meetings that public sector banks have with the government, is there any move to remove that 20% cap that FPIs have? it is not serving any purpose. They will buy what they will buy, irrespective of whether they are allowed 20%. Because of that, IIFL has made a calculation that SBI is losing some 1.4 billion of passive inflows. You are losing some $200 million of passive inflows. Is there any discussion at all that this cap, that sentence is just dropped?
Look, as far as Indian banks are concerned, going forward, let's say we talk about next 5 years or 10 years, banks would require capital. So, I mean, that's something we require it. But with the FDI cap, it's a policy issue which the stakeholder would take a call. Obviously, the data you are presenting is known in that way. The stakeholder would take a call with regard to that. But as far as banks are concerned, definitely going forward, although our CRAR is quite comfortable as on today, and that can take care of our requirement for going forward. At the same time, on a 5 years or 10 years horizon, possibly bank would require capital and possibly the call would be taken at the right time.
Yeah, fair enough. One hopes. I know this is a question to the finance minister and not to you, but I was only wondering if it comes up in your discussions. Just a final question. Are you all tapping the capital market in any way? I mean, either sale of your stakes in any of the subsidiaries or even holdings like NSE, or even raising capital for your own sake. Look, your competitor, State Bank, has raised 25,000 crores. The market is kind to banks who have done well. Any way will you approach, either for your subsidiaries or for yourself, either for selling or for raising?
So there are two aspects here. One aspect is your own capital raise. We had announced to the market earlier that on a medium term, we intend to raise roughly around 8,500 crore of equity that we already announced, but at a time where it would be required for us to raise. So immediately there is no plan as on today. At the same time, on the monetization of the assets, subsidiary asset, already there is a plan. But again, I mean, all this monetization depend upon the right valuation, which is again one of the important factor for us to consider. So a couple of our assets like subsidiary, the divestment or the IPOs are in the pipeline. We are discussing also how do we again come out on that. So that would continue, like the moment we get an opportunity time, we'll keen to monetize that. But as far as bank's own capital is concerned, as on today, we are well capitalized. At the same time, yes, there is a plan to raise capital in a medium term, not immediately. But you are right that the market is kind. I mean, at the time, we'll take a note of that and then decide on the matter.
Yes, the market is certainly kind. Your stock is in the green, though Bank Nifty in general is not doing too well this morning. Thank you very much, Mr. Chand, for joining us with your thoughts. We leave the market in kind of cautious optimism, if you please, although at the moment I should say cautious pessimism. Stocks across the board, the indexes are in the red. Mid-cap is about a little better than the rest. Let's see if after the first hour of caution, the market perks up. Wrap up on Bazaar chart busters coming up.